Hello, this is Hurran will be with you with a short review on U.S. personal income, spending, and inflation data and market reactions. The data which almost had no surprise, but had some important points to watch. Uh, this short review of this data, and then I want to talk a little bit about the yesterday's data as well, because these data together will tell us will give us the better idea of the market condition. Let's see what we were expecting. Core PC price index on the monthly scale expected to increase by 0.2%. Same thing happened. Core PC price index on the annual scale supposed to stay unchanged at 2.9%. Same thing happened. PC price index is expected to increase to 2.7% from previous 2.6%. Same thing happened, but remember, it increased. In line with expectations, but increased. And PC price index on the monthly scale, in line with expectations, increased by 0.3%, more than 0.2% of July. But so far we didn't have a surprise. But what is important here to watch is the personal income. The personal income increased by 0.4%. That's very important to remember. 0.4%. The personal income increased by 0.4%, which means that more than expected, same as we had in July, which means that the people still they have a money to spend. Okay, fine. And personal spending increased by 0.6%, more than 0.5%. PC price index, the inflation is about 3%. Spending is about 6%, income is about 4%. All is data together, putting these numbers together, telling us that the people's income is more than spending. People's spending is more than, income is more than spending. Even like if you adjust inflation also, still the people's income is fine. So the people's, they are making more money. So it means that the saving also can increase. It means that the market, the power, the purchasing power is fine. These numbers means that. Putting together the yesterday's data, yesterday we had some important data to watch from US labor market. As you know, initial jobless claims, we had yesterday initial jobless claims in the US. We had here, yeah, initial jobless claims in the US. Here's the data. Initial jobless claims in the US increased by only 218,000. Continuing jobless claims slower down by more than 2,000. 4 weeks average down to 237,000. GDP increased by 3.8% in the second quarter, while the GDP price index increased only 2.1%, much less than 3.8%, but still slightly above the expectations. GDP sales jumped by 7.5%. Putting these data together, telling us that the economy in the United States moving fine, and also add this that the core durable goods orders increased by 0.4% and durable goods orders increased by 2.9%. So these data together telling us that the US economy is moving fine. US economy is strong still, and it can support the higher rates for longer, while the inflation is still near to 3%, not to 2%. So this economy can handle the higher rates for longer. As a reaction, if we look at the reaction in the market, Fitwatch tools still that's before the market published, but probably it's going to change. More than 87% chance. Yeah, still the 87.7% chance of 25 basis point rate cut for October, which it was 94%, 93, 94%. And now there is more than 12% of holding the current rate, which it was around the zero, like 2 days ago, 3 days ago. Now that as much as we are going forward, the market counting on less chance for another rate cut in October, which I think it shouldn't be happen, because the another rate cut in the current situation is risky. Probably we can have an auto rate cut, but in December it can be more logical. But if we cut the rates in October, we're supposed to hold the rates in December, and two rates cut right after each other to increase the markets. It will increase the liquidity in the market and the risk of inflation. So that's why the October rate cut is really out of the table. should be out of the table by looking at the economic side. And as a market reaction to this data means that we can expect a little bit more hawkish reactions and more hawkish tones from Federal Reserve. So this data means that the higher rates for longer still should be able to be handled in the US economy. Market risk 17.95, still high. It's around the market risk is around 18. It's much more higher than expected 15. Looking at the dollar index, 98. The dollar index still trading at 98. This data cannot, I mean, the dollar index, which increased in the last 3 days, with these numbers cannot be under pressure because these numbers cannot support the idea of the lower interest rate, lower inflation. These numbers still can confirm that the inflation is still increasing in line with expectation. At the same time, we have more income, more spending, which in favor of the higher prices. Because when you have more spending, when you have a more income, the companies, they are not. I mean, they have no reason to cut their prices or lower the prices. So the higher rates, higher prices can continue. So that's why we cannot count with these numbers. We cannot count on the lower prices in the next month. So that's why I mean these numbers, they are not in favor of the holding the. They are not in supporting. They are not in favor of supporting the slowing inflation. I mean, they are not in short words. They cannot support the price fall. So the inflation is still there. That's why the rates shouldn't be down too fast. These numbers, while these numbers are, about the gold, let's first talk about the stock prices, and then we can go towards the gold. Stock prices, positive reaction at this, the first reaction. This positive reaction shouldn't go long. I mean, that can be just the initial reaction. This initial reaction cannot go further because these numbers, they means that the inflation risk is still there. While the inflation risk is still there, so we should think about the rate, the holding the current rate, not the rate cut. So that's why this initial reaction is not logical, and we should be able to see the lower prices. So higher rates for longer is not in favor of the gold, but at the same time, putting the stock markets under pressure means that it can support the gold price. So these numbers means that with these data, we can expect the side movement, or at least we can expect the gold to be able to hold its gains, but they are not supporting any idea of cutting the prices of losing the market momentum. As for the energy market, they cannot support the energy price, but energy price in the market and oil gas price in the market these days is really under this affecting by the geopolitical tensions and updates. So the economic data are important, but now we are in a condition that the geopolitical news and tensions are having a much more effect on the oil price. Today we're going to have the meeting in the Security Council of the United Nations about the Islamic Republic in Iran. And if they agree on some points, probably there is the request from the Russian side. If they agree with the Russian suggestion, probably we can say that the oil and energy market can go slightly slider, and we should have less tensions there. But it's depend if they accept the council will vote for that or not. So it's very complicated meeting today. It's very complicated meeting. The way that you're voting and the overall situation is very complicated there. On the cryptocurrency market, we can say that these numbers cannot support the idea of just like higher rates, but I mean the same effect that it will have for the stock market, it can have for the cryptocurrency market as well. But they are not a data that we say that okay, these numbers are too much affecting directly on the crypto market. So these numbers wouldn't affect the crypto market directly and too much, but still they are not in favor with these data that we have are not in favor of the cryptocurrency prices. That was the US inflation numbers, personal income and spending, and market expected reactions. Have a good time. Bye.